Well, there we go. And good evening and welcome to the Digital Finance Analytics live stream for the 20th of November 2018. For those of you who don't know, I'm Martin North, the Principal of Digital Finance Analytics, and I'm afraid I'm responsible for all this stuff. So welcome to those joining. We've got a huge number on tonight. It's great to see. I'm not going to start reading everybody's names out at the moment, otherwise we'll never get beyond, but I will take a look as we go. It's really good to hear from where people are from all over the place. In fact, it's great to see. Well, from Sydney round to the US and a few other places too, and of course New Zealand as well, and Perth. So it's great. Okay, so what I'm going to do now is I'm going to just run through briefly at the start of this a few formal slides, and from then what I'm going to do is to open it for Q&A. So just for the moment, I'm not going to be looking at the chat screens because otherwise I get distracted on what I'm saying. So I'm not being rude, I'm just not going to be looking at the moment. I will come back and look at the chat a bit later. So with that said, I'm going to now switch across to the screen now. Last time, those of you who are on, I actually forgot to show the screen, so you just got my ugly mug, but this time I think I've probably done it correctly. So just to set the scene a bit on the running order, what I'm going to do is this introduction, which I've done, talk about the house rules. There are just a couple of things I want to say about that. I'll talk a little bit about our models and how we get to the data that we get, because it's important for you to understand how that all works. A couple of, 6 or so slides just on some information that I think is very current. And then we'll go into the questions and answers. I've got a bunch of questions from beforehand, but I've also got plenty of opportunities to take your questions, and I'm happy to answer hopefully anything you ask me, providing it's roughly to do with property and finance. There may be things that I can't comment on, and I'll say that I won't bullshit. I think it's important that, if I say I don't know, then take it I don't know. If I do know, I'll try and tell you. And then we'll sign off. This will probably take about an hour. It might run just over that, depending on how much conversation we have. To be honest, sometimes I could go on for 3 or 4 hours, but probably better not to at this time of night. So just on our house rules, please note this isn't financial advice. I don't know your personal circumstances. I'm not allowed to provide financial advice. It's illegal for me to do so. Please don't take it as that. This is my general opinion based on my research and all the information that I've been sharing with you. But nevertheless, we can have a very good discussion about some of the broader things that are going on at the moment, and hopefully you'll find that helpful. Please play nice in the chat room. We've had a few shenanigans over the months when we've run this. Basically, there are a lot of smart people on the chat this evening. Let's just respect each other and look at the opinions and conversations. This is at the 20th of November 2018, if you're watching the recording. This will go up as a live stream afterwards, and then what I do is put up a version up which is a trim, so you don't get all the pre and post chat. It just basically is the program, but it is at the 20th of November. And if you want to get my attention through the next part, once we get to the Q&A, use @WalkTheWorld to get my attention. Frankly, there'll be so many people making comments as we go through that I won't necessarily see them unless you actually draw it to my attention by using Walk the World. Okay, so just briefly on the model, this is the way I think about the world. So we have all our various research flows coming in from the customer focus groups and consumer surveys, the SME surveys, and other information. We also have anonymized information from our other clients. All of that, plus the information from the industry, goes into our core market model. And that's where we've basically crunched all the numbers and produced all the various reports, all the stuff that goes up on the YouTube and on the blogs, as well as custom assignments. And that's been running now since 2003. Well, we actually started in 2002, but 2003-04 was really the first full year. So we have a bit of a history now around the data. And because of that, we can manipulate the information all sorts of ways, looking at it by customer segment, by location, by different geographies, different drivers as well, and owners of property. The surveys are only Australia-based. We don't yet have a survey based in New Zealand. Now, depending on the interest from New Zealand and whether we can find a way of doing it, we might do that as well. But anyway, we can certainly read across from the Australian data to New Zealand. Now, just a few quick points. The Reserve Bank minutes came out today. I always try to do this on the day that the minutes came out. It was very upbeat And there was an IMF report out today, very upbeat again, based on, I think, what the RBA and APRA told them. But there were sort of a few interesting points. The first comment in the minutes that prices had fallen further in Sydney and Melbourne. We sort of knew that. Conditions have been stable in most of the other cities, although they say housing prices declined a little further in Perth. In fact, in Perth, prices have gone sideways and down for 4 or 5 years. And this is important. Rental vacancies have increased in Sydney. We're actually seeing rising stock, both in terms of those for sale and also those for rent. And we'll come back to that because that's critical. Second point is that the easing in credit growth is likely to reflect the tight lending conditions. The lending conditions are way tighter than they were, and also weaker demand. They also make the point that the new rates, the attractor rates that the banks are offering for new business is way lower than those with existing borrowers, and hence the conversation about mortgage prisoners that we'll probably have later on. In other words, if you're somebody with a less good sort of profile now under these new underwriting standards, you could end up with a loan that's at a much higher rate and you can't get out of it. And then the third one is that the funding costs have been higher. That reflects the bank bill swap rate and LIBOR. Of course, banks take funding from overseas to be able to fund their books. And the modest increase in funding costs earlier in the year have been passed on by most lenders to existing borrowers with variable rate business and housing loans. So again, if you're an existing borrower, you'll be paying more. If you're a new borrower, potentially you won't. Just in terms of some other data points, this is the latest annualised RBA data. So credit in Australia for housing is still growing at 5.2%. So let's not believe that the whole thing is falling over completely. That's still a strong amount of credit growth. It's dropped from 5.4% last month. And of that, owner-occupied is growing at 7.3%, so that's a lot of refinancing, some first-time buyers, and some people trading up and trading down. But property investors are significantly lower. That's the yellow dotted line down to 1.4. And so we are seeing the absence of property investors being the first part of the catalyst. But interestingly now, even owner-occupied borrowing is slowing, and my view is it will slow further ahead. Mortgage stress is still rising. We report on this every month. It's 30.7% of households now are having difficulty making those mortgage repayments. And remember that the RBA data shows 190.5% is the debt-to-income ratio. That's one of the highest in the world. Never been higher in Australia. We have households with very high levels of debt, and therefore no surprise that mortgage stress is rising. In fact, data came out today from the ABS showing that real increases in wages have been really very slow, much slower than some would expect. And that's consistent with all the other data that we've seen, plus, of course, the rising levels of costs. They're all there still. The BBSW, this is one way of measuring the changes of funding. It's 17.5% gap between where the low point back in February and now. So that effectively means that for the 40% of funding that banks get from overseas and from the interbank markets, they are paying more for. They haven't passed all of that on yet, so my view is we're going to see more rises ahead. Just on Bitcoin, I wanted to highlight this because there's been a whole bunch of things around Bitcoin. You know, there's a lot of people who believe that Bitcoin is the future of the currency. And I have to say that I've always believed Bitcoin was pretty speculative. Well, it's dropped again, 11.27% down today. Not least because we've had this fork in Bitcoin, but also because the Japanese Financial Service Agent said it plans to regulate virtual coin wallets. They're actually looking at it more like a bank account now, which is quite interesting. And the US Securities and Exchange Commission has compelled 2 crypto startups to register their tokens as securities offerings. And that's really part of this crackdown relating to Bitcoin. So we're seeing the regulators bear down. And in fact, the IMF published a report quite recently suggesting that maybe central banks should issue their own digital currencies. So that might be worth exploring a bit further. Financial services continues to be under pressure. This is the ASX turnover financials. You'll see that 5614, they're way down. And in fact, if you go back over the last year or so, they were a lot higher. So, you know, the banks are really feeling it, not least because of all this tightness to do with lending, the Royal Commission, more funding costs, and a whole bunch of other things. Now, this is quite interesting. This is UBS Latest Scenarios. I did talk about this at some length in my weekend update, so I won't go into detail, but just to highlight that they run 5 different scenarios. I'm a great fan of UBS. I think they actually do a lot of good stuff. And so they say, look, at one end you've got a strong economy through to a deep recession. mis-selling and basically legal action to the banks. And at the worst end, they've got housing prices peak to trough greater than 30%, whereas in scenario one, it's through the worst. They're sort of suggesting that it's probably towards scenario 3, I think, at the moment. But UBS is probably at the sort of the more gloomy end, along with me. There are others that are less gloomy, but nevertheless, quite a few of the banks are actually talking about the fact that house prices will continue to slide. And some people have asked me, well, why is it that a lot of banks don't seem to be actually registering very significant falls? And I think it's quite simple. If you are a large bank and you've got an economist department as part of that bank, the data that the economist feeds into the broader bank will actually need to form a basis for their strategy and their measuring of risk in their banking book. So if they start saying 25 to 30% drops, they have to increase their provisions. So therefore, the economists that are inside the large banks have a significant reason not to not to move the loss rates down or the price falls up, because if they do, that would actually have a very significant financial impact on the bank, because they have to put more capital aside, therefore their performance would go. So there is a direct link between what those economists are saying and the forecast that they make and the provisions that the banks will make. Now, just in terms of my scenarios, I've updated them. Those of you who've been following my work for a little while will know that I have out of the back of my model my scenarios. And in fact, I have 5 scenarios. Scenario is just a way of exploring different outcomes, because I'm never going to actually sort of say definitively it's going to be that. I want to give you a range of views, then you can perhaps make your own decisions as to where you think the weight of the evidence lays. So we have 5 scenarios: business as usual, things going to get better, not yet doomsday, Armageddon, which is equivalent to Ireland 2.0, or doomsday, which is Iceland 2.0, as I call them. And you can see that for each of those we'll have things like the RBA rate, the unemployment rate, the degree of mortgage stress, the losses, what home prices are doing, whether in fact we're going to see the governments intervening in some unnatural way. And also I weight each of these by way of a probability, so you can see how my modelling is going. So at the bottom end, there's now only a 2.5% chance that it's going to be business as usual. So, the RBA rate stays where it is, unemployment stays where it is, mortgage stress stays roughly a little higher, losses, well, not too bad, home prices 10 to 15% down, and no unnatural acts. There's a very small chance that that is going to play out, despite the fact that quite a few of the bank economists are still saying that that is where they think the truth lays. The next one is things going to get better. Here now we see easing credit rules because essentially they want to continue to build momentum around lending. I think home prices could easily go 15 to 20% down. This is a national average. It's probably a bit higher in Sydney and Melbourne and a bit lower in some other places. Probability now has moved from 35% last month to 30%. So there's less than a 32.5% chance of those first 2 scenarios being where it plays out when I look ahead 24 to 36 months ahead. Not yet doomsday is the next one. This one is the essentially, pretty serious now. Potentially one bank will need a bit of a hand simply because they will have issues with their mortgage book. We're going to see bank losses rising. We're going to see mortgage stress rising. We're going to see unemployment rising. The Reserve Bank will be forced to cut the rates. Lift the rates because of the exchange rate movements and effectively trying to deal with supporting the dollar. And there's a 20 to 30% price fall in that model. And that now has a 42.5%. So that's effectively a relatively, high proportion of the probability sitting there. It was 40%, so it's gone up. Armageddon. So this is now where effectively the Reserve Bank cuts rates down to 0.5% or to 0. The unemployment starts to rise. Mortgage stress rises, bank losses rise, home prices are now 30 to 45%, and there'll be bail-ins and bail-outs. And this is triggered not really just by way of local issues, so those first 3 are based on what happens locally, but this is much more to do with an international crisis. It could be the US debt bomb over there going off, or it could be to do with China and trade, or it could be to do with Europe and Brexit, or any other number of, events that could trigger a financial meltdown. It could be Deutsche Bank wobbling or whatever. All of those things are potentially in the mix. And if one of those flows through and we get hit with an international tsunami, then effectively all bets are off as to what happens locally. So this is effectively like GFC, 2.0, I suppose you could say it. And of course, Ireland there effectively bailed out the banks, put a lot of money into the system, and it's taken them 10 years to try and work through. And then the bottom one is Doomsday. This is Iceland 2.0. John Adams will love this one. This is essentially where we take the RBA rates down to zero or below. So there's QE and a lot of stimulus. The unemployment rate rises significantly. Mortgage stress is huge and through the roof. Bank losses are very significant. Home prices here in this scenario could drop significantly. Some are saying down to 80%. And there would be bank failures and quantitative easing, and it's about a 5% probability now. That is the doom and gloom scenario in a way, but it's also not completely unrealistic if, in fact, we don't get a bailout. And I suspect that it's very likely that we would get a bail-in or a bail-out, because if you look at the recent Treasury speech that was given, they talked about how they bailed out the banks last time and essentially are preparing to do it again if they need to. So there you go. Those are my summaries to give you a bit of a flavour for what we're seeing. And that's where the midpoint is. So if you want to sort of take the 50% point, that's where it is. So we're thinking that in the next 3 years, we could certainly see one bank in difficulty. We could certainly see home prices 30% down and significant rises in mortgage stress. And, the Reserve Bank rate perhaps a little higher than where it is now. Some would say perhaps they will cut slightly, but in this scenario, we're expecting a slight rise, which has a knock-on effect. So I hope that's been of some use, just in terms of setting the agenda for tonight. One of the things I'm doing this time, because I was asked by one of the people last time, was to have on the final version effectively a recording of the chat. So I'm recording the chat as I go. So I'm just going to go up to the top. There are lots and lots of comments. Somebody said I'm the Australian housing bubble messiah. I'm not sure about that, but I'll take it. Newcastle, Sydney, Sutherland Shire, I think we've done some of those. Barossa Valley, South Australia, from Katrina 000. Okay, good. Neutral Bay. All right, now let's see whether we can get to some of the questions. I'm looking for Walk the World. Please run a survey in New Zealand, says Andrew. I'll do my part in promoting it. Thank you. Okay, well, it's interesting. What I need to do is to get some of the banks in New Zealand to help pay for it, because essentially it is going to be quite a costly exercise. But I actually think, based on the issues that I'm seeing, it could well be that there is an opportunity to do something around that. And, Joe's recent contributions have highlighted, I think, the lack of real transparency in New Zealand. Somebody also suggested using the surveying your viewers, my viewers. Yeah, the Robbie, yeah, it's interesting. Of course, the problem is you're self-selecting, right? That's part of the problem. So, to be accurate and useful, the surveys have to be effectively statistically robust. But what I may do is perhaps find a way of getting some informal feedback from you guys too. Okay, going down. What else is there? Okay, yeah. So some people are talking about Harry Dent. So. So those of you who I think may or may not have seen Harry, we did a program the other day with Harry. He's walking around the country at the moment, and I know he's run a couple of events which were reasonably successful. Harry, of course, has a particular point of view. You don't have to agree with him, but he's pretty clear around a few things, some of which I think are quite relevant and some of them less so. I see that Joseph Wilkes is on. 22 clearance rate at Barfoot and Thompson, Auckland, down from 26% last week. Now, that's interesting. So we're seeing a lot of clearance rates dropping, and that's true in New Zealand, it's true in Australia. And there are two things happening. The first is that some of those clearance rates are because we've got lower volume coming onto the market. Secondly, of those coming onto the market, more are being withdrawn, But I think it's also important to highlight that there are more private sales, certainly in Australia, than we had previously. So it's not as simple as simply saying because auction clearances are way down, the market is completely stuffed. There are still transactions taking place. However, if you look at the latest data, you'll see that around there's a 20% drop in settlements compared with a year ago, and in fact probably more now. Remember that there's a lead time, quite a significant lead time between those transactions and seeing the data. What I can say is that if you compare the 60, 70, 80% clearances we had last year, it's way down. And now everyone's saying, well, maybe it'll be quiet before Christmas and then pick up after Christmas. I have to say, I think that is a little bit unlikely. Okay, somebody was talking about Bitcoin, saying, this is Mark, it could go down to zero. Yeah, how do you value something which is a speculative asset? That's the question. Genevieve's talking about that must be Harry. Yeah, you can still get tickets if you want to for the events that are still to come. If you go to the recent video that I did, you can actually find a link there where you can actually make a booking. Now, Jay has asked, is the ABC doing fair reporting on housing? Well, it's a very interesting question. I think they have. So they did the Four Corners more than a year ago, and they talked about mortgage stress and all the stuff that I did there. And just so you know, there's a possibility of doing a 7:30 report. I'm in the middle of talking with them about that, so watch to see whether that happens. I think they've tended to be careful, and certainly the Media Watch thing on the 60 Minutes was a bit shameful in my view, but they're probably better than some of the other channels. I guess that's all I'll say. Okay. Genevieve. Okay, what are you asking? Different suburbs have gone. The greater lift, the greater the fall. Ask Martin. Yeah, exactly. Thank you very much. So I think the question is, I'm just trying to decode what the question is from that particular one. Do use Walk the World if you want to get my attention, because I'm going to go straight for those. How much have different suburbs gone up is a very good question. It is not uniform. So, for example, if I take Sydney as an example, Ultimo units now 22, 23% down from where they were. If I look at some of the southern Shire, some of those are down 15%. If I look at some of the places near the coast, a little bit less so. If I go inland, significantly down. But then if I look at other places, then prices are much, much more level than they were. So you have to go granular to really understand what is going on. The same is true in Melbourne. Units, I think, are moving down quite quickly. I'm actually watching Melbourne. I believe that Melbourne prices are moving now down faster than Sydney. They ran up later, and I think they're probably falling faster. In fact, mortgage stress is now higher in Melbourne than in Sydney. And my expectation is that the Melbourne market will be the one to die further and fastest. And in Melbourne, more property investors are now underwater from a cash flow perspective because of the rental returns than Sydney. If I then go to somewhere like Auckland, later. If I go to Adelaide, for example, their prices are still, not really moving down very much. In fact, many will say that prices are still moving up a little, as there are in Hobart. The rate of increase is slowing, however, and the question is, to what extent can those smaller markets continue to go higher as the larger markets get ever more compressed? Brisbane going sideways. There are a few postcodes in Brisbane where there's still some upward movement, particularly in houses. Units towards the centre of Brisbane definitely struggling. And if you go out to the Bowen Basin of the mining areas, you'll see there are lots of falls there. And if you look at the Northern Territories, they've had a pretty shocking time with prices sliding there. Volumes are way down as well. Again, we've had a spate of new building in the Northern Territories. A lot of that is looking pretty sick. And if you go over to Perth, there in Perth, you're seeing home prices continue to go sideways or go down. And you may have noticed the recent post, very helpful guy from Perth who's a property investor, explained a little bit about what's happened to rental yields because, of course, the rents are actually going down there. So Perth looks pretty sick. I see no evidence at all of any movement up in Perth. Scenario 10, says Aldi, move back to your mum's rental. Yeah, maybe. Okay, let me see what... You left out scenario 6, hell on earth, Venezuela 2.0. Yeah, you're right. I mean, how many variations do you want? The problem is I have to try and model each of these, right? And the problem is that the more parameters and different scenarios I generate, the more complicated it is. So I'm going to stick with those at the moment. Now, Peter's made a very important point. This is Matt Corrin from CBA saying 40 to 50% of loans were approved using HEM. Yeah, we've got a big issue with HEM. So, as you know, household expenditure measure was used dramatically across the mortgage industry for a long, long time. And essentially, what that meant was that people were getting loans they shouldn't have got. And the household expenditure measure was a rough ratio. They tended to impose it on pretty much everyone and use it as a gate. So if you could, still basically afford the loan based on the household expenditure measure, that's all they looked at. They didn't look at real expenses. Now that's changed, of course. Everyone's now pulling in more expenses data, but loans are still being written on HEM. So there is a significant proportion of very poor loans having been written. And the average borrowing power is now down about 40%. Other measures would also suggest it's down. You have to take an 80% of the rental stream rather than 100% if it's an investment property. You have to make an assessment based on principal and interest, not just interest only, even if it's an interest only refinance. And the forensic analysis of costs is not just a point in time, but essentially you need at least 6 months history. So what that says is if you are thinking of wanting to apply for a loan next year, say, in March, April, May, you need to actually start demonstrating your capacity to live within your expenditure budget now so that you can then present the data to the banks. Without it, it's going to be tough to see. So all this tells you that this is not the end of the tightening. This is just part of the tightening. And Peter said CBA found that HEM was used on 75 to 80%. Yeah, that's pretty true. Most of the others were also using HEM. And if you listen to the early Royal Commission discussions, basically the brokers would capture some of the expenses information, throw it across to the lender, and then basically the lender would do absolutely nothing with it, which is a bit crazy, I guess. Okay. It would be great to see the summary outcomes with the changes of probabilities over time. Yes, okay, interesting idea. Could do that. Again, it's all a matter of just manipulating the data a different way. But essentially, my bearishness continues to get a little worse, simply because as the data gets... somebody's nearly missed it because of Queensland time. Glad you made it. Essentially what happens, of course, is that as the scenarios change, then effectively we try to respond accordingly. Okay, let's see what else I can find. Whoa! Now, just a few hundred ones come up there. Hang on, let me go back at the list. Okay, so let's now talk about bail-in. So this is Michael Patterson. Are you any closer to getting any clarity from the RBA, the government, over bail-in? Okay. Short answer is not a lot. We have now got a number of pieces of documentation from a number of politicians, both from the Senate and from the House of Reps, where they've written to individuals and have confirmed that bail-in legislation was passed earlier in the year. Now, despite the fact that many people who've got letters from Treasury or from other politicians claim there was no bail-in, I can tell you that we've now got a lot of evidence to demonstrate the fact that there was a bail-in. So the question now becomes, so what about deposits? Is deposits in or is deposits out? As you know, my position is it's unclear. There is certainly a line of argument to say that you could definitely see a scenario where deposits could be bailed in. The official position is still deposits won't be bailed in, but there is nothing really definitive in writing. And in fact, I think the way to deal with this is to effectively pass an amendment to that earlier piece of legislation to expressly reduce the risk of deposits. So take deposits off the table, basically say bail-in does not include deposits. That's what should have happened. That's in fact what the amendment that was put out was trying to do, but it got overtaken by events. So we're going to talk more about that, not today, but in an upcoming episode, because I've got some more information on what's going to happen and how that might actually get up. But at the moment, essentially, the formal position from APRA and from RBA and from the government is there's no bail-in. The official position, though, is not, I think, the true position based on the correspondence that I've seen. So it's still up in the air. I think bail-in is still a real risk. And of course, in New Zealand, it's absolutely there on the table. Have no. In New Zealand, the Reserve Bank of New Zealand has a complete strategy for a deposit bail-in in the case of a bank failure. Okay, now Dale's asking about regional Victoria. Some areas, yes, good question. So, of course, regional Victoria has not run up so much and is a bit later. We're seeing it a little bit in some of the other regional centres, but I have to say, I think it's a matter of time. Essentially, we're going to see, I think, some of those regional areas flow back down. And, of course, from an overall perspective, if you think of the weight of borrowing and the number of loans out there, frankly, it's all about Sydney, Melbourne and Brisbane, and then a little bit of Perth and the others. So even if you see some stability in the regional areas, and I think that there is going to be more stability there, my own view is that it's really those major centres that really are creating the problem. Don't see that changing anytime soon. Okay, now what else have we got? Demystifying money. Central bank to issue its own digital currency. Isn't that fit? Yeah, so here's the thing. So they're arguing, this is what the central banks are now arguing, that you cannot leave digital currencies to the crypto world because they are actually high risk, uncontrollable, and effectively disconnected from the money supply. That's essentially what they say. So what they're saying now is maybe it's time now to consider the formalisation of digital currencies issued by central banks. And in fact, there are a couple of central banks around the world who are experimenting with it even now. Not in Australia, but potentially later. So what we're going to see is blockchain being used potentially in a couple of different scenarios, right? The blockchain used for the public and also for the private crypto as well. It's definitely from where we were to where we're going is very, very much in flux. And that's another reason why I think the Bitcoins are struggling a bit at the moment. Okay, now what about us? Okay, so Cody said, what about satellite cities like Newcastle? Okay, yeah, I did some work, in fact, for a particular client quite recently around Newcastle, and we looked at there. So there are signs of cracks happening there as well, particularly in houses and around Newcastle. There was a bit of run-up, not as much. My own view is that we're going to see the regional centres like Newcastle and Wollongong continuing to move south, not as quickly, because essentially they didn't have the same run-up. But the same forces, the same tight lending, and also the fact that incomes are not as high in those centres suggests to me that we're going to see more corrections. And there's also quite a lot of new building going on there, and as indeed around Wollongong as well. And we think that supply-demand disequilibrium means that we're going to see prices continuing to fall. Joe White said, congratulations on the 10K. Yes, well, let's just have a quick celebrate of 10K plus. It's amazing, isn't it, when you think that I started the year with a very small number and we're now at 10K. I really appreciate all your support and assistance and help and comments with all of this. It's been quite a ride. The good news is we've got plans ahead to make it develop even more next year, and hopefully we're going to be able to bring in other characters into the mix a little bit more as well. People like Joe, of course, people like Edwin, John Adams. We'll have some others as well. Because essentially what I'm trying to do here is two things. I'm trying to make sure that there's a really strong core about data and what data is doing, but I'm also trying to deal with some of the other perspectives too, because I don't want this just to be an echo chamber with a single voice saying it's all doom and gloom, right? What I'm trying to do is to bring different voices to bear so that you can then make your own decisions. Right, so what have we got now? Let's have a look. Okay, Okay, Glenn's asking about the Gold Coast. Yep, and I've had a few people ask about the Gold Coast. Look, I'm looking at rental returns on the Gold Coast. They don't seem to me to be going the right way at the moment. And as a result of that, there's a huge supply of property up and down the Gold Coast, a lot of construction still. And I'm seeing weakness in terms of demand. So my expectation is, I'm afraid, that the Gold Coast will slide down. I'm particularly worried about units, particularly those that were bought at the top, because I think they were bought full priced or too priced. Okay, is mass migration being caused by needing to import new debtors? That's from Bieber. Yeah, very interesting question. Of course, a big debate now about migration. Now, just to be clear, just to be really clear, the biggest lever for home price growth is credit availability. Migration and indeed foreign investors are there, but they're not the major reason to drive prices higher. Or to turn it around the other way, the tightening of credit is by far the biggest reason why home prices will continue to fall. And as I explained earlier, with the tighter lending standards, 40%, with the 35 to 40% rejection, in fact, it's 41% of applications being rejected at the moment, according to my data. It suggests that many people are having great difficulty now in getting credit. So home prices are effectively sliding down. Now, people will argue that migration supports home prices, but as Edwin made a point in one of his recent videos, a lot of those migrants coming into the country can't afford to buy here, and therefore even migrants are not necessarily directly responsible for a lot of the home price growth. I think foreign buyers probably did help to lift it, plus investors more generally, but foreign buyers are 35 to 40% down from where they were, thanks to tightening in China and higher fees and charges for foreign buyers, and also the fact that the demand from property investors is really fading away. And of all the things that are going on, I think the property investors is the most interesting. So my surveys tell me that many property investors now who are worried about the current situation are beginning to think about, should I sell? So whereas there was a fear of missing out and wanting to get in and ride those prices higher, now it's a fear of not getting out. That's by far the most significant thing that I'm seeing. And quite a few people are now saying, if I don't actually see any improvement quite soon, with the rental streams that I'm now getting, plus the other costs of running a rental property, this is unsustainable. And of course, if Labour comes in and also further tightens the negative gearing rules, another reason why property investors may well actually decide to leave. So there's a real strong switch in my read from property investors. They are definitely not that active and will not be active going forward. The other group's very interesting. I'll talk about first-time buyers. And I've got a whole bunch of questions from people who are first-time buyers saying, look, I've saved up. I'm thinking of buying in Perth, or I'm thinking of buying on the Gold Coast, or I'm thinking of buying in Brisbane or Sydney or Melbourne, right? Should I or shouldn't I? Now, I obviously can't give you, full information recommendations, but let me make 2 points. Firstly, unless you think that home prices are going to start recovering, I can't see any reason why any first-time buyer with savings in the bank would not hold off unless there's an absolute need to go and buy something because you've got to find somewhere to live. Because one, rentals are actually in greater supply and the cost of rentals look to me to be easing. And two, if you do buy, and let's say you put in a 15% deposit, remember that you lose that deposit in a falling market. So, if you get an 85% mortgage and prices drop 15%, you've lost all of your savings. The bank still has the mortgage and you still owe it to the bank. It's not equally spread between the two. That's really important for people to understand. So I think unless there's an absolutely burning need to buy, I would hold off. I've been saying this for a few months, but I'm actually more convinced now than I was previously. And frankly, I think that's true pretty much anywhere across the country, even in places like Hobart and Adelaide, because I don't believe that those peaks are going to be sustainable. And certainly in New Zealand, in fact, I did a conversation with Joe the other day, which hasn't gone up yet, will come up quite soon. Joe was making the point that in New Zealand, it's first-time buyers who are being allured into the market with cheap rates and everything, because effectively they're seen as the easy pickings to try and keep the property market going. Again, be very careful, do your sums, even bearing in mind that rates may rise. But the critical question now is, if capital continues to fall, think about the implications. Okay. More congrats on the 10K. Thank you for that. Now, CoreLogic only shows capital says, yeah, that's true. Of course, auctions don't happen so much in other places, so it is a little bit a question of they report on those things. I think the auction clearance rates are pretty rubbish, not least because there are a lot of people who don't report non-sales. And if you look at the number that are proposed to be listed compared with the number that actually are listed and offered, it's much lower. So, I could argue that the real clearance rates are significantly lower than previously. I guess the other point is that as the volumes drop, then the accuracy of the numbers also tends to go down as well. Okay, now Adam asked, is there anything we can do to protect our super? Well, okay, so it depends a little bit on where your super is and how it's invested, right? So if you have a self-managed super fund, then you can obviously make your own investment decisions. Certainly look hard at equities, because equities, I think, are under pressure. I think we're going to see more sliding in the equity markets around the world. As Harry said the other day, Harry Dent said, not sure whether this is the start of the big slide or whether we're going to have one more high before it slides down next year. Don't know, but I think equities are in difficulty. Of course, a lot of super will probably be in bonds and other fixed interest structures as well. And the question is, if it's not in self-managed super, but it's in a managed super fund, then who's managing it, right? So if it's a retail fund, then it's going to be managed probably by the big banks. Those big banks are also exposed, of course, to derivatives and to other potential losses. Now, they are built into a trust structure, so in theory, those assets should be maintained, but nevertheless, it's going to be quite a bumpy ride in terms of performance. If you actually have an industry fund, again, they tend to have better performance. They tend to have lower fees. They're probably also a little bit less risky. So my own view is the industry super funds look to me to be a better bet compared with the retail funds at the moment. And not least because the returns are better, but also because I think the risk profiles are better as well. But yeah, it is a bit risky, I agree. Okay, now Luke says, do lenders have to show the LMI policy documents to the borrowers? Interesting question. Lenders mortgage insurance. Okay, so LMI is either provided by an external provider like Genworth or QBE LMI, or it's provided by a captive LMI or a pseudo LMI by the bank. Now, it very much depends on the documentation, depends on the particular structure that you're using. In some cases, all you get is a very short form summary of what LMI is. Remember that LMI does not protect the borrower. The LMI protects the bank. So if you default, then the bank gets the money back. Doesn't mean that you don't still owe the LMI. Very important to understand that. So it's a risk transference rather than actually protecting borrowers. And I think there's a big issue with LMIs, and I've said on a number of occasions, to my mind, the whole LMI question is one that should be looked at. In fact, the Productivity Commission in their recent report highlighted this. The risks are unclear, the benefits are unclear, the costs are unclear, the pricing is unclear, and frankly, if there was a run on prices fell and there were significant defaults, the LMIs would be in significant They have lots of capital assets, they have lots of investments, but they are, of course, also protected only by the value of those investments. So as the stock market's performance drops, the LMI also has issues. And that's one reason why, for example, Genworth share price is still languishing. Okay, regarding baby boomers now retiring, how will this phenomenon go to play in our financial difficulties? Yeah, very good question. This is from Eric G. Now, many baby boomers have still got a mortgage even as they enter retirement. That's unusual. So normally what happens is that people actually pay off their mortgage as they approach retirement or on retirement. But it looks to me as though now we have a high proportion of people who have mortgages, sometimes investment properties, sometimes owner-occupied properties, sometimes both, with mortgages. What that means is that they're going to be reliant on probably either selling the property to repay the loan or continuing to pay those mortgage repayments in retirement. Now, that's a new situation, because essentially the question now is then, will baby boomers be able to actually maintain those mortgage repayments? And in fact, my mortgage stress indicators suggest that some of those baby boomers, as they've entered into retirement and their income deflates, are now struggling. So I think this is a really important sleeping issue. In some cases, it may end up as needing to sell the property and effectively using that to be able to repay, or using some of the retirement savings to repay the loan, and potentially going on the government pension. So the whole thing looks to me very messy and high risk. Okay, thoughts on liar loans. This is from Wendy. Thoughts on liar loans. Yep. Liar loans are a big deal, and there's two flavours of liar loans. There is where consumers didn't give the full disclosure to the broker or the lender. And we know that in the past, people didn't necessarily have to give the full story simply because they were being asked for specific information. And of course, if you had a pulse, you could get a mortgage pretty much. And then, of course, the lender didn't worry about the expenses anyway. So in many cases, what's happened there is that the information has not been accurate. Now, UBS is suggesting that a significant proportion, maybe as many as 40% of loans, are potentially liar loans like that. But there's another set of liar loans, and that are those where effectively through the underwriting process between the broker and the bank, effectively things were changed or altered or otherwise reduced, such that effectively when the bank made the underwriting standard, they didn't have the full information correctly into the system. I think that is also systemically there too. So there is definitely a subprime. It's very, very hard to know how much of the market is subprime, but I think it is significant enough. Remember that the 90-day defaults are rising a little bit. It's still very low, but it's rising a little bit. And my own feeling is that we're going to see a lot more of this coming out as interest rates rise, as default levels perhaps rise, and as the question of being stuck in a loan that you can't refinance really comes to the fore. That's one of the reasons why I think the chances of a class action are still quite significant. And, you know, I don't know what form it will take, but effectively there are various things going on. Maurice Blackburn, for example, looking potentially at how to sue the banks in a class action for making bad loans. I think we haven't seen the end of this yet. Okay, now Daryl's asked, when will you and John do a piece on Senator Amanda Stoker's response letter regarding bail-in? Yeah, we've got some more to do on bail-in, as I said. We'll come back to that. There's a whole lot of more to say. I'm not going to have a chance really to take it to you now. But just to say that there is clear evidence that banks did, in fact, the government has effectively allowed banks bail-in to happen. It's a question of whether it's deposits or whether it's not. So I'm not going to answer that today, but I'll answer it later. I'm just going to take a drink. Excuse me a second. I'm running myself hoarse. Only water, just so we're clear. Okay. New Zealanders on this stream this evening, please share this post. The Aussie banks are a very big risk to New Zealand. Thank you, Joseph. Yes, absolutely. The interesting point there is that, of course, most of the banks in New Zealand are in some way connected to the banks in Australia. The IMF, when they did a recent review of New Zealand, drew attention to the fact that the Reserve Bank in New Zealand needs to actually be much closer to and work with the regulators in Australia because of that deadly embrace. And if the banks in Australia struggle, very high debt, then we're going to have issues in New Zealand and vice versa. Now, I was talking to somebody earlier on today, and hopefully we'll do a video on this in the next few days, that the funding situation of the banks in New Zealand is worse than the funding issue of the banks in Australia. And if that is true, and they are more exposed, then essentially the whole question of how that plays out is significant. But I think absolutely right. There is a significant deadly embrace risk between Australia and New Zealand. And remember, in New Zealand, deposits are there to be bailed in. It's absolutely clear policy, no ambiguity. In Australia, it's completely ambiguous, and nobody's quite sure what the situation is. In New Zealand, deadly clear. So, New Zealanders, just be aware that your deposits are potentially at risk. Okay, next one. Where do I see the Aussie dollar? This is from Flying Individual. Where do I see the Aussie dollar in a year's time? Well, my own view is it's going to be below 70. I've thought 64, 65. I think the Reserve Bank will sacrifice the dollar to try and maintain the momentum in the economy. Of course, the risk is you import inflation, which may have an impact on interest rates. But the fact of the matter is that I think it's hard to see it going a lot higher. But it does depend a little bit on what the US does. If the US blows up and there's a whole amount of debt in the US and interest rates are rising and will continue to rise, the Fed is going to put the rate up, the cash rate up, probably in December and then again next year. That's going to put ever more pressure on corporates in the US, many of whom have borrowed at very low interest rates to pay effectively and buy back shares rather than actually to invest in the business. So they're actually highly leveraged. So that could be a reason why it would be different, but I think at the moment I'm reading a lower Aussie dollar in a year's time. Now, Richard K is asking about negative equity. Yeah, there's a whole bunch of work that we're doing. In fact, I have a geographic map of where negative equity is worse. I'll do some posts on that. We can do some geomapping so you can see which... oops, it's just died. Sorry, my thing has just timed out. I need to put it back on, otherwise I can't control anything. Bear with me. So I'm just explaining that I'm using a Perl streamer here, and that Perl has a switcher, and the switcher is controlled by an iPad, and the iPad just decided to time out on me for no real reason, so sorry about that. Okay, so we were just talking about negative equity. Yeah, there's a bunch of issues. Werribee is a very interesting area where there's a lot of negative equity. A lot of other places too. So watch out, Richard. I'm going to do a separate post on the geomapping of negative equity. I've got all the data to do that. And Joseph made the point as well, just on Northern Rock and RBS. They were extremely profitable before the crash. Yes, exactly right. The fact of the matter is that we won't know until it hits. And when it hits, it potentially will hit quite quickly. And Brett said, my shirt's a beauty. Oh, I'm not sure whether that's polite or whether you're actually criticising it. Anyway, this is the one that I wore when I interviewed Harry Dent. So there you go. Okay. Are your correction predictions a percentage Australian average? Yeah. Yes, Josh, it is. Perth not falling as far because you've already had significant falls over the last few years and no real rise. I still think that Perth could go lower by 10 to 15% if it really went bad. Whereas, of course, in Sydney and Melbourne, we're talking way more. But Perth is still relatively overvalued relative to income. That's the problem. Okay. Now, Robbo's asking, the price drop is from peak. So I've basically said where we were at the top to where we were at the bottom. So I'm talking 40% from there to the bottom. And it could be even longer. And Wendy said, I envisage being bailed in. It's scary. It is, yes. It amazes me that there wasn't more reaction in New Zealand when the bail-in stuff was actually publicised. Or maybe it wasn't publicised. Maybe that's something that we can do a conversation on post this. But to me, New Zealand followed the global trend for bail-in. The FSB published the guidance. New Zealand followed on. Australia sort of did it, but hooked it, as we said earlier on. But in Australia, it's unclear. In New Zealand, it's totally clear. Okay. What else have we got? This is from Kerry. What do you think governments will do to reduce the extent of recession likely to accompany large reductions in home prices? It's a very, very good question. So I believe that we're going to see more unnatural acts. What I mean by that is things that are effectively a bit stupid, but you can see why they're doing them. For example, they announced the $2 billion securitization for small businesses last week, which is a small amount, but basically it's another securitization play. So it's using the financial markets yet again to try and kick the lending can down the street again. I expect a lot more of that ahead. And the fact of the matter is that we think that, as things get tighter and as prices go further, we're going to see more in the way of unnatural acts. Now, that could be first owner grant stimulus packages. It could be other types of incentives. It could be, for example, using superannuation in some way to cross-fertilise into the property sector. The problem we have is that anything that effectively turns the property price cycle up again and the credit growth up again is leading for even more significant problems later. And that's simply because we have too much debt, we have too high home prices on any ratio. Prices are at least 40% over their sort of normal term. And that suggests to me that we will potentially see... Here's my worry. We have an election probably, let's say, May next year. To go into an election with 20% price drops in home prices would be pretty disastrous for the incumbent government. So I'm expecting some initiatives before then to try and kick the can down the road and then put it in Labour's lap, who I think will probably win the next election, which is a bad deal, but I suspect that's what will happen. So yes, I expect more of unnatural acts. Remember that last time also we got a capital injection from the Fed to help our banks through. And it's possible that we may see something like that again, because essentially the international financial system is all connected to each other and nobody wants to rock the boat and nobody wants to see it fall over, right? Which is why there'll be huge pressure on the Australian government and the Reserve Bank to find ways to keep the bubble going forward. Okay, the Hills District, this is from Fly Individual. Yes, so I'm looking at that, and prices there are still relatively bullish. There is some evidence now of some sliding, but it doesn't seem to me to be sliding as much as, for example, places like Liverpool or Campbelltown. But I'm also noting that the volumes of transactions have dropped significantly, and I think that's probably what I'd say. So to my mind, supply and demand look out of kilter, so I think we're going to see falls. Are social implications being considered in each of the scenarios? Yeah, indirectly. I mean, I do try and, when I do my videos specifically on the scenarios, I do talk about the implications. John Adams is very hot on this. He says, look, if there is a big recession or a downturn or a depression, then people are actually going to get into a whole bunch of issues. And if Ireland is any guide, we're going to see more suicides and we're going to see more crime and all of those things. This has a direct consequence on the broader society. And that's why this is such an important question. Why? The thing I can't get my head around is why the Reserve Bank and APRA and everybody else is just propagating this. Everything's fine. It's all going to be perfect, rather than actually recognising that we have a significant set of issues and start to act. But even, as we've discussed with John in one of the other posts, a lot of the politicians really don't want to countenance this downside. In fact, whenever I talk to them, they say, well, you're talking the economy down, aren't you? Well, I'm not sure I am. I think I'm just trying to use the data that's there to highlight what I think the real issues are. But, So, yeah, I think the social consequences are very significant. Now, Philip in Auckland said... Never seen so many signs go up so fast as they have in the last month in Auckland. Yeah, that is a very important leading indicator. And again, we'll see in our post coming shortly how the volume of on-market properties are going through the use, through the roof. We're going to see a whole lot more property, no doubt about that, on for sale. Okay, well, we're nearly on the hour, and I haven't really got all the way through. Let's just have a quick look to see what else. Yeah, but offset accounts, are they unscoped? Jonathan says, interesting question. It's hard to know. I suspect that the right of set-off will come first. In other words, they'll net off deposit with the loan, but it's not clear, it's not documented, nobody quite knows. But that would be my hypothesis. Can't really tell you more than that. I've spoken about Newcastle, so I've done that one. Do you think the Royal Commission could end up as hot air again? Once it's over and the government ease lending, yeah. This is from Bam Bam 21. There is a risk. Look, the fact is that the Royal Commission has been a very powerful sort of spotlight on the financial system. And frankly, many of us in the industry already knew that this was exactly what was happening. But of course, there was no way of getting it out into the public domain and getting people to realise what was going on. The culture of the banks need changing. The culture of the senior executives in the bank are just found wanting. And the question is, can they change? And I suspect probably not without major change. There was a post I did about a week ago with an ex-director of ANZ Bank, and he talked about what really needed to change. And I think it's worth looking at that. It's a long one, but it's worth looking at because essentially, you've got to think about significant change. The problem is that those recommendations then go to the government. What will the government do with those recommendations? They might sit on them. They might be lobbied by the banks. Probably will be. And of course, the power of the banks and the relationship between the banking sector and the government is such that it could well be that some of those issues will effectively get swept under the carpet. However, I think it's so clear that the stuff that needs to be changed, that some things will happen. We just don't know how much. I think what I would say is that it's down to us, individuals, to lobby our politicians and make sure they understand that we are not going to let them get away with just sweeping it all under the carpet. We can't afford to let the debt bubble inflate again and the home prices inflate again. We have to get back to a more sustainable future. We have to get back to a banking system that is supporting real productive lending, not just inflated home price lending. That's the key question. All right. So this is from Ray. What do you think the effect of the loss on world reserve status of the US dollar would have? Yeah, on the Aussie dollar. Good question. Look, the whole question is what's going to happen to the US dollar? There are people who are saying the number of other countries are now accumulating gold so that they can effectively move towards a different set of currencies that are not connected directly to the US dollar. And it could be that the US dollar is then sidelined. The fact is that Australia is so directly connected to what happens to the US dollar that it's going to be it's hard to see how that plays out effectively. I think that the risks there are quite significant, but it's part of this broader question about what is the evolution of the financial system going to be. Is it going to be, GFC 2.0, another bunch of quantitative easing and more asset bubble inflation? Is it going to be replaced by something completely different, gold-based or some other based or crypto-based or whatever, or what? And that's the open question. So I'm not sure I can give you a firm answer on that. Now, I missed one, which I think is quite important. Generally speaking, do commercial property prices mirror residential during a crash? Sort of, yes. There's two parts to that. Firstly, there is the construction of residential property by commercial entities, and that's sliding back. The number of new starts are down. The number of builders who are now not buying new land and, in fact, in some cases selling land is going up. And we are seeing the rate of completion dropping. So that's the first point. More broadly, the commercial sector is also responding, not least because, in fact, it's harder to get lending for commercial reasons. And, in fact, some of the tighter underwriting standards are flowing through into the commercial sector. So my own read is commercial property tends to follow rather than lead residential by about a year to 18 months. Okay, now Darren's asked, what do your numbers say about future values off the plan apartments? Is what I'd say. John Adams arrived. Anybody seen Australia's gold? Hello, John. Come back to that in a second. About future values of off the plan apartments. Yeah, they're going down. So typically, according to my connections I've been talking with, the valuation between the off the plan original agreement and what is actually now being valued by the banks when it comes to getting the loan is down 15 to 20% on average in Brisbane, Melbourne, and in some areas of Sydney. That's a big deal. So that means that basically people thought they could get this amount of mortgage and they can get this amount of mortgage. In some cases, they're running away. And in fact, some of the foreign buyers who signed up off the plan are also not completing. So this is a big deal. And I think we're going to see further price falls in off-plan apartments. My own view is that that is where a lot of risks are. Particularly, I'm really, really worried about Brisbane apartments. Massive oversupply, continued construction. I'm really worried about Melbourne apartments, and I'm somewhat worried about Sydney apartments. Okay, any thoughts on the CSR share price? No, I don't have anything to say about CSR, I'm afraid, so sorry about that. HEM used over LMI insurance contract avoidance. Now that's interesting, Peter. Yes, so yes, Peter's made an interesting point there. Could the lenders' mortgage insurers essentially go back to the banks and said you didn't do your underwriting standards correctly? Now, maybe, but in fact the way it works is that information is passed across to, for example, Genworth, and they have their own underwriting processes inside their own organisation. So if the information was incorrectly passed to a lender's mortgage insurer, potentially they might have an out. If not, then it's harder to see. But yeah, it's an interesting question. I hadn't thought of that. Good point. Okay, what else have we got? Okay, economic awareness. Waiting for a train. That's an interesting name. Most people do not seem to think about there's any threat to the economy from their housing slowdown. Does your survey measure economic awareness? Yes, it does, and you're correct. Most people have no idea about what's going on. Most people are still effectively plugged into the mainstream media if they watch mainstream media, and might be a slight wobble on auction clearance rates, but everything's absolutely fine, and buy your next property. You can never lose on property. More people still believe that property prices double in every 7 years. And about 70% of the people that I survey still believe that you can never lose on property. So we haven't got very far down the road of getting people to understand the reality. But there is an important alternative reality here, and that is that essentially some people will be losing their shirts because of the way the property market is going. Jonathan and I spoke about Newcastle earlier on, so replay that if you missed it. Retail is really suffering. This Christmas will be toughest one yet. Yes, I agree, Gareth. All of my data on mortgage stress suggests to me that there are many people who are rating their savings and also effectively putting more on credit cards, but they're running out of runway. And if you look at the people in mortgage stress, there's about 30% of the households in mortgage stress, they're the ones without the ability to be able to actually borrow much more, nor indeed to be able to effectively spend out this Christmas. So yes, I think this Christmas is going to be very, very gloomy when it comes to household expenditure. Now, there will be some people who say, I'm just going to put it on credit cards and clean it up in the new year. We always see credit card debt rising in the new year. And there is still a lot of loose lending on credit cards, and indeed personal loans and payday loans and other types of credit, including some of these pay ahead type propositions too. So there's lots of credit out there for people who want it, but of course all that debt has to be paid. Remember that debt has to be repaid. Some people seem to assume that you can get away with not repaying it, but unfortunately that's not real life. Okay, now this is from Chisel83. I'm in the eastern suburbs from Adelaide, and the amount of new construction going on is astonishing. It is, absolutely. It amazes me. Look at Hobart too, and look at Canberra, right? There's massive amounts of construction in Canberra, another interesting place where people are thinking of buying. Somebody asked me, one of the questions beforehand, first-time buyer in Canberra, should I buy in Canberra? I think no. I think the prices in Canberra will drop, not least because the next election, assuming Labor gets in, will, I think, probably be a bit of a disruption. It always slows down prior to the election. And the other point there is the construction that's going on, massive amounts of supply, demand is finite, so I would watch carefully. In fact, clearance rates are highest in Canberra at the moment. I think that's a mistake. Okay, I think I spoke about the Gold Coast earlier on, so I'm not going to speak about it again. Do you recommend fixing interest rates on a mortgage? Very interesting question. Now, question is, why are you wanting to fix your interest rate? If you can get a really good low rate now for 3 years or 5 years, then the chances are that you'll do pretty well. But there's always a risk, of course, that rates may fall. However, the thing about fixing an interest rate is that you have certainty. And so, to my mind, the reason to fix an interest rate on a mortgage is more about certainty rather than the absolute dollar value, assuming that it's reasonable. But bear this in mind, the fixed rate that's quoted on a mortgage is derived of what's called the implied forward rate. So it's basically on what the yield curve is looking like ahead. So it has some connection with where current and future yields are expected to be. So it's not completely disconnected. In many cases, the fixed interest rate will be priced off that same curve. So it's a question of whether you'll want to take the risk of being able to ride rates lower, or whether you want the certainty of a fixed repayment structure on your mortgage. And in fact, many people will say that that certainty, that fixed rate, is worth a lot, bearing in mind I said earlier on it's likely that the banks will have to put their mortgage rates up next year as the cost of funding continue to grow. We've got to 9:15 pretty much. I'm still wading my way through some of this, so I'm just going to have another look and see what else I can find. I'll take 3 or 4 more questions, and then I think I'm going to probably wind it up for the night. I think we've covered a lot of the questions. Now, there was one question that a number of people asked beforehand. We talked about the bail-in and the bail-out, but not the deposits. So the question that was asked, and it's being asked a few times here, is should I split my savings across multiple banks to be able to protect that the savings that I have, if I've got more than 250k, because essentially we know that the deposit insurance structure is actually to 250k per account per institution. So the answer is, I think, yes. It's worth spreading it. Frankly, that's what I've done. So I've basically spread across. I've also looked at some of the smaller players and some of the regional banks and some of the credit unions and building societies who actually have a much lower risk profile. You can tell that by their capital ratios. And you can also see that they're not exposed to derivatives and some of the other stupidities that some of the big guys are also exposed to. So my own view is that that's quite a smart thing to do. Remember that deposit insurance kicks in when a bank has fallen over, whereas deposit bail-in, potentially, or other types of bail-in, will be activated before a bank falls over. So just think about the implications of that and the sequence. If you have a bank that gets into difficulty, right, the regulators may decide to bail in to protect the bank, which means they don't have to then trigger the deposits insurance when it falls over. So a lot of the correspondence from the politicians, when people asked about bail-in and bail-out and deposit insurance, came back with a complete morass between those two things and basically somehow linked bail-in with deposit insurance. They are two separate things in two different scenarios. It's very important to understand that. But I think spreading the risks is good. And you got to. If I were thinking about how to deal with my finances, I'd make a decision about where I thought the scenarios are likely to play out. Across those 5 or 7 or whatever you want to do. And once you've worked out where you think the scenarios are, then you say, what's my critical requirement to protect what I've got, or to try and find a way to invest and speculate, right? So the strategies are completely different. And then you would make some different strategy calls and choices depending on that. I often find when I talk to people, they're confused between speculation and asset protection. In other words, keeping the value of what you've got versus trying to create more wealth out the back of it. Okay, rental yields are great in the Gold Coast. Is that holding prices up? To an extent, yes, it is, Glenn. Although, what I'm noticing is that the rental yields are not as good as they were. And I'm not sure why that is, other than the cost of managing properties may be going up. But you're right, Gold Coast, Queensland, Northern Territories, great rental places. Victoria, New South Wales, not so good. In fact, Victoria is the worst. More than half of Victorian properties are underwater from a cash flow perspective from investments. Okay, now this is, have you considered the implications of the US entering recession? Yes. Automatic stimulators kick in. Yeah. So that was my sort of late scenarios, right? If I go through the scenarios, my scenario 4 assumes some sort of international problem, US enters recession, more quantitative easing. The quantum of quantitative easing that would be required this time, compared with last time, is dramatically bigger. And the question is, can the global economy do that? Maybe, maybe not. Okay, I've talked about Canberra, I think. Somebody asked about that, and my mouse is just stuck. More information on the Brisbane property market would be fantastic. Okay, Bron. Look, I think what I'm going to need to do, because I'm running out of time now, is clearly there is a lot of interest in the local economies and the local things. So maybe what I should do is to just cover do a particular post in a smaller area. So over time we can begin to build up a bit of a matrix of the different locations. So I'll undertake to do that over the next little while. And perhaps perhaps the way to do that would be to do it piece by piece over time. So I undertake to do that when I have time. Time is, of course, the essence with some of this. Okay. Now, whoops, what happened there? With all this incoming turmoil, what are you observing when these national markets' reactions to our debt and equity and dollar starting to slow exit or holding? Yeah, there's a lot of exiting. So basically the risks in Australia are seem to be high. So when I talk to my international clients, they're looking at the Australian market and looking to short it. So in some cases they're shorting the banks, in some cases they're shorting retail, in some cases they're shorting the currency. There is a significant view forming, despite what the Reserve Bank is saying, that the risks here are quite high. And the yield that we're getting here relative to the US is low. So therefore, my own view is we're going to see effectively international investors going away. Okay, just on the Reserve Bank, yes, the Reserve Bank is in fact owned by the government. It's mandated by terms of reference that effectively comes from the Treasurer to do with inflation. So it's independent, but it's actually part of this Council of Financial Regulators, ASIC and APRA and the Reserve Bank and Treasury are all involved. So it's sort of connected and it's not connected, but it's not private. It's not like the Fed. The Fed is privately owned and run. The Reserve Bank is not. Okay. So, can we quickly have a Glass-Steagall? Can I quickly have a Glass-Steagall? Well, sort of. Okay, here's the thing. The derivative risks around the world are massive. 592 trillion of derivatives out there, I think was the last number I saw. Massive amount, high risk, highly speculative. Many of those are owned by banks that also have mortgages and other products and services. It was basically created by banks wanting to speculate and to connect their retail banking with their speculative operations. Glass-Steagall came in 1932 after the crash to separate it out. It was brought in for a number of years. It was then taken away in the US. Clinton actually signed it away. 10 years later, we had the GFC. We need that separation because what that means is at the moment, if the derivative markets go wrong somewhere, that could flow over and gobble up deposits and basically then create a banking crisis in our mortgage books and in our deposits, right? Glass-Steagall is a way of separating. There's a draft bill in Parliament at the moment. The CEC was responsible for getting that up via Bob Catter. And I think it's probably behoven on us to try and encourage our politicians to take this seriously. I also put a paper into the Royal Commission on this very point, and you can actually see that on the website, and there's also a post on Glass-Steagall. Okay. The CEC never talk about the Glass-Steagall. Yeah, very good. All right. Okay, so I think that's it. I'm going to just go back to this other... let's go here, go here. Okay, that's the Q&A. So just to finish off, a couple of minor points and then we're going to close out for tonight. So just to say, if you like what you've seen here today and all the work we do, please do consider supporting our efforts. There's a lot of effort, a lot of work, a lot of time that goes into producing the material. This has become now pretty much my main activity. I do also do some consulting and stuff on the side. I have 166 Patreon followers now, 34 new ones this month. A few have left, a few more joined. There's different tiers. If you go to the higher level of tier, you get a whole bunch of additional content. I know that some people don't like Patreon. I am looking at other payment mechanisms. Believe me, it's quite tough to do, but I am going to see whether I can do things like PayPal, tip jar and those sorts of things. It really is a critical part of helping us to cover the costs, all this stuff that we do, because we actually spend a lot of time and effort and money doing it, you know. So please consider Patreon. Every contribution and every comment is really welcome, and also you get some special content that you can't see if you're not a member. Just on the top hits, there's a few things to say. There's a post that I did on when I was actually at UBS. I was involved at the conference there. I spoke about the housing sector. Some very interesting, well, I think interesting comments that were to a massive audience of 250 people. A lot of those were reported in the press. There's the Harry Dent interview that I did, caught up with him and spoke with him about particularly the role of central banks. I've got some other content with Harry that I'll perhaps take some bits out and put that up later as well. Talk about Joe Wilkes from New Zealand. Great to have Joe on board and to talk about the New Zealand end of things too. Really terrific content from him, and there's more to come. Of course, we're continuing our gold quest with John Adams. The Reserve Bank says, shut up and go away. Still more to come on that. Still more to come on bail-ins. There's another post coming on bail-ins shortly that will update you where we're there. And we're still doing our mortgage stress and our other pieces of analysis. I'd be interested in your comments either now or later as to whether you want more of the interviews and, you know, commentary and multiple perspectives, or more on the analysis side, or have I got the balance right? I also want to update you that the Capital Markets series is still on the stocks. I haven't forgotten about it. I saw a few comments earlier on, but frankly, the problem has been that I've had so many other things on my mind, and, you know, the Royal Commission and everything else. So actually, it's been quite difficult to do, but I will try and get to that sometime soon. And I've got a whole bunch of content, and it's, you know, quite powerful and hopefully really useful. So tell me whether you like to have this up on the screen as well. So I want to say thank you very much for your time and for spending time with me. We've had today, just give you some statistics, more than 600 people at the peak on the stream, which is pretty amazing. So thank you. And look, spread the word, guys. You know, this is something which is really important. You know, it absolutely makes a significant contribution, I think, to the debate in Australia. Watch out for more media stuff. The good news is I've got some more media stuff planned. Watch out for more content from John Adams, from Joe, from Edwin, and a bunch of other people too. And yes, I know about the renaming of my channel. No, it's hard to do. Just take it from me. Take it from me. It's hard to do. Bearing in mind where we are. So I want to say thank you very much. Really appreciate your time. Thank you very much for spending time with me today. Have a good evening. And I'm now going to sign off until next time. And just so you know, I'm hoping to do one in December before we end the year. And that will be a little bit of a slightly different format, because we're going to be talking about what we think 2019 is likely to be. So thank you very much for your time. It's been great spending some time with you. And what I'm now going to do is sign off and hopefully get a drink. It's Martin North from Digital Finance Analytics. Many thanks for watching. See you next time.